What's the importance of credit when buying real estate? Coming up. Kai here with the Kai Wong team, helping you better understand everything you need to know about New York City real estate. I have Scott Nadler with the Loan Depot here. Hi, Scott. How are you doing today?
Hey, Kai. How are you?
I'm good. Can you introduce yourself a little bit?
Sure. I am a residential mortgage loan officer with Loan Depot. I've been in the business now for close to 9 years, and I work with people who are buying homes or those who need to restructure or refinance their current loan.
Great. So in this video, we want to talk about credit. So tell us a little bit, what's credit and why it's important?
A credit report will tell us and will give us a snapshot of someone's ability to repay debt. The better they are at repaying debt, the higher their credit score is going to be.
Okay, so do you run the credit for every one of your clients?
We do. It's really important for us to do a credit check with all 3 credit agencies. So that's Equifax, Experian, and TransUnion. And we will take the middle score for an individual, and if it's a couple, we'll take the lowest middle score between the 2 of them to use for qualifying.
Got it. So since we're talking about scores, what's the range we're talking about?
You could see scores as low as 350, which I don't think we've ever seen before, and as high as 850, which we have seen.
Okay.
Typically, we're looking to see scores at 700 or above. If someone has a score that's below that, it doesn't mean they're not going to have options. There will be options available for them, but by and large, we are looking to see clients with credit scores of 700 or up.
So what are the 3 things to consider when we're talking about credit?
It might sound counterintuitive, but the more debt somebody has, the better it is for their actual credit score. So think about it this way. If I wanted to borrow money from you, you would want to know if I've ever borrowed money from anyone else previously. So the more people who are vouching for me and saying that I pay back my debt and I pay it back in a timely manner will give you the confidence that I'm going to pay you back. Credit works the same way. So if I have 3 credit cards and I have a student loan and I've made all my payments on time and I have a long history of making those payments on time, my credit score will increase.
Okay, so in a way, it's kind of like your reputation, right?
Exactly. Now, for the client that only has 1 credit card, it does make things a little bit more complicated, but it's not a non-starter. Okay. Oftentimes we can verify that someone's been making their rent payments, which doesn't show up on the credit report, but it does verify that someone has been paying debt on time. So there are alternative ways of looking at it if someone doesn't have the standard 3 trade lines, meaning 3 sources of debt.
So 3 sources of debt, we're talking about anything from credit cards to student loans to car payments to mortgages, kind of.
Absolutely.
Got it. Okay. So what's the second thing to consider?
So it's also really important to think about keeping your balances low. Okay. So if someone, for example, has a $10,000 limit on their credit card, when we go to run that credit report, we'll want to see a balance at 50% or below. So if they have a balance of $3,000, that's good. But if they have a balance of $9,000 and their limit's $10,000, that's not so good, and it's going to bring their score down. So oftentimes when we talk to clients, we'll ask if they carry any high balances. And they may say, I just bought a lot of furniture and I ran up a big credit card bill. We'll wait for that credit card bill to be paid off or paid down, and then run the credit shortly thereafter.
It's really just to show that, like, okay, I have self-control in a way, that you're not going to overspend and overextend yourself.
Exactly.
Got it. Okay. So what's the third thing to consider?
Do all lenders look at credit the same way? And the answer is no. Every lender's going to look at it a little bit differently. Some are very credit score driven, where it's very important for them to see a higher score. Others aren't so credit score driven. They're more concerned about what's actually in the report. For example, someone may have a medical collection on their credit report for $30. That may not be a big deal for some lenders, even though that collection account may bring their score below the 700 score threshold. It's really important to understand all the little nuances when it comes to someone's credit. And then for someone like me, it's important to play matchmaker, to match up their loan along with their credit with the right lender to make sure that they can get a loan.
Got it. And that's very important. That's why I tell my clients all the time to speak with a lender, find out what works for you. So the lender's job, in a way, is really to make sure that you're getting the type of loan that works best for you and your financial situation.
Absolutely.
Overall, in a way, is the higher the score, the better interest rate you're going to get, and the lower the score, you still get the loan most likely, depending on which lender you're working with, but you're going to pay a little bit more in terms of the interest rate.
Credit is a very mysterious thing, and it's really important to understand everything about the credit, not just the score, but what's in the report.
Of course. Okay, awesome. Well, thank you so much for sharing.
Thanks a lot for having me.
Thank you so much for watching the video. If you have any questions or comments, please leave it below. If it's your first time here, consider subscribing. In this channel, we share with you buying and selling tips, market updates, and neighborhood guides. So see you in the next video. Bye.